Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate speak so you don't have to. Today, we're diving into a shareholder report so packed with numbers, it's like trying to understand a toddler explaining quantum physics. Prepare for a wild ride of debt, returns, and maybe, just maybe, a glimmer of understanding. This report is like a financial roller coaster, filled with corporate bonds, yields, and a healthy dose of past performance is not indicative of future results. Let's buckle up and see what's really going on. First up, let's talk about costs, because who doesn't love knowing where their money is going? For the Muzinich Credit Opportunities Fund, if you had a hypothetical $10,000 invested in the institutional class, it would have cost you $68 bucks this past year. That's like 3 fancy coffees, or to put it another way, it's 0.67% of your investment. So how did this fund actually do? Well, it had a positive return, which is good, but it didn't quite beat its benchmark, something called the ICE-BOF A Global Corporate and High Yield Index USD hedged. Basically, markets were a bit topsy-turvy thanks to rising US government yields. The fund made some moves, decreasing cash and treasury positions and investing in corporate credit. They also reduced the fund's duration, which is a fancy way of saying they tried to be less sensitive to interest rate changes. High-yield bonds and floating-rate paper helped, but avoiding the riskiest stuff, those CCC-rated bonds, cost them some potential gains. It was a year of calculated risks, it looks like. Let's zoom out and look at the bigger picture. Over the past decade, the institutional class of the Muzinich Credit Opportunities Fund has averaged a 3.24% annual return. Not bad, but the last 5 years have been rough, averaging only 1.93%. Past performance doesn't guarantee future success, but it's good to know if your horse has won any races before. Now for some quick stats. As of the end of 2024, this fund had about $160 million in net assets spread across 267 different holdings. The advisory fee came in at about $949,000. The portfolio turnover, a measure of how frequently the fund buys and sells its holdings, was 164%. This is more than 100%, meaning they changed their entire holdings more than once. Where was the fund investing? It looks like good old US Treasury bills were their biggest holding, accounting for 5% of the fund's net assets. After that, Ford Motor Credit and CaixaBank SA make an appearance. Moving on to the Muzinich Flexible US High Yield Income Fund, let's see how much that $10,000 investment would have cost you. This fund's institutional class is slightly cheaper, costing you only $60 bucks, which is an expense ratio of 0.58%. How did the fund actually do? Well, it produced a positive return. Fund performance versus the benchmark meaningfully benefited from exposure to lower-rated credits, including our off-benchmark exposure to CCCs. Now let's look at the average annual return numbers since this fund is younger and hasn't been around for a full 10 years. It started on March 27, 2017. The institutional class without sales charge boasts 7.65% this past year, 3.11% for the last 5, and 4.04% since inception. What are they holding in this fund? The top 3 are the CCO holdings, First American Treasury Obligations Fund and Service Properties Trust. Those are some wildly different areas of industry. Lastly, let's look at Muzinich Low Duration Fund. If you had a hypothetical $10,000 invested in the supra-institutional class, it would have cost you just $52. This makes the expense ratio 0.50%. Okay, so how did this one do? The Muzinich Low Duration Fund produced a positive return, comfortably outperforming its benchmark, the ICE-BOF A 1 to 3 year US Corporate and Government Index. By duration, the 1 to 3 year bucket was the best performing, and at a regional level, Western European credit selection contributed to the outperformance. An overweight and strong credit selection of BBB and BBB-rated bonds contributed to positive outperformance. Let's dive into the numbers. Here, the supra-institutional class comes at 6.30% this past year, 3.06% over the last 5, and 3.44% since inception on June 30th, 2016. It consistently outperforms. As we can see here, the top 3 issuers are First American Treasury Obligations Fund, Ford Motor Credit Co. LLC, and Standard Chartered PLC. This is a much safer and secure style than the first 2 we just looked at. Okay, shifting gears a bit, let's talk about the checks and balances. No changes or disagreements with the accountants were noted. The company has a code of ethics for its top executives. We like to see that. The audit committee is pre-approving all services from the accounting firm, hopefully, keeping everything transparent and above board. Now, what's my take on all of this? For the Muzinich Credit Opportunities Fund, I'm seeing a fund that's trying to navigate a tricky market but might be playing it a little too safe. It's generating positive returns, but underperforming its benchmark suggests there might be some room for improvement in its investment strategy. The heavy reliance on US Treasury bills could be a safety net, but it might also be limiting its upside potential. I'd want to see more diversification and a willingness to take calculated risks for potentially higher rewards. The Muzinich Flexible US High Yield Income Fund, on the other hand, seems to be taking on a bit more risk, with higher exposure to lower-rated credits. While this boosted returns this year, it's something to watch closely, especially if the economy hits a rough patch. Again, we also see big positions being taken in dramatically different areas, media, real estate, etc. That always raises my eyebrow and makes me consider if I could just manage it better myself by buying individual company bonds in each sector. The Muzinich Low Duration Fund seems to be the steady Eddie of the group, with consistent outperformance and a focus on capital preservation. Its lower expense ratio and slightly higher yields are definitely appealing, especially for more risk-adverse investors. I like how its top holdings represent a mix of safety and high yield that make the top positions very strong and consistent. Overall, the funds are being managed by a competent team that is transparent in what they are doing. As always, you need to keep a close eye on those fees, that's key, and make sure you know how that fund aligns with your investment goals. That's all for today's dive. If you enjoyed this corporate decoding, please remember to like, subscribe, and leave a comment. What reports are you looking at? See you in the next one.